Hello and welcome to our office hours presentation for today. This is Paul Hoyt and it's great to have you here. Our office hours presentation is a relaxed, informal, and free mentoring program that I do every Monday at noon Pacific time. This recording will be available online as well as many previous weeks' recording, and all recordings and lots of documents and files will be archived in our members area. The reasons I'm doing this is because I know that being a successful business owner can be a tremendous experience, but it's tough. You really need training in a lot of different ways in order to overcome obstacles, avoid making a lot of mistakes. And I also want you to get to know me, because when you know me, you'll know that I really do care about small business owners, and I want you to succeed. Our agenda today is pretty simple. We're going to have an in-depth discussion of a business success principle and some closing remarks, some special offers, and an invitation for next week's session, and then open questions and answers. First, questions and answers relative to the subject of the day, and then we'll just open it up and take questions from all kinds of different topics. And speaking of topics, today's topics is on Money Talks, the process of financial modeling. I always try to relate the subject to one of the key performance areas, and I define 7 different key performance areas of business in my first book I wrote in 2004 called The Foundation Factor, and in my Beyond Business Survival program, and a lot of the coaching and consulting work that I do. We talk about these different key performance areas and how important it is to be competent in each one of these areas. And today's presentation is squarely in the area of financial management. In financial management, it's where you're responsible for managing cash, for making financial projections and cash flow forecasting, for managing your funding, for really focusing on the value of your business, and that's what financial models are really used for. On today, we're going to have a brief overview of financial modeling and why we're talking about that, and then we're going to go step by step through the financial modeling process that I have, and I'll show you those steps here in just a little bit. But first, the overview. I just have to start with a confession, is I just love accounting. I know that some of you out there don't love accounting. When I first learned about the double-entry bookkeeping system and the history of that, and how you've got debits and credits and assets and liabilities and deferrals and accruals and all of that, I just fell in love with it. Didn't happen until after college, but I quizzed out of a 10-hour course in accounting in about 1975 or so, and really have liked accounting ever since. And I also love to do financial models, because I spent the first 30 years of my career in the information systems or the computer industry, where we programmed computers, large ones, small ones, medium ones. And financial modeling is a little bit like programming computers with the macros and the links and some of the things that I do that are a little bit interesting in the financial model work. So I know that some of you out there don't like accounting and you don't like to do financial modeling, and that's a great reason for you to get somebody like me on your team. I've done 150 or so of these financial models, so I'm very experienced at it. And my focus is always to create what I call an investor-grade financial model. An investor-grade financial model typically has 6 worksheets with it. There's 2 for each of the income statement, the balance sheet, and the cash flow statement. One that is year over year for either 3 to 5 years, and the other one which is month by month for the first year. Every once in a while I get somebody that says they want month by month for all 3 years or all 5 years, and that's not a problem. That's fairly easy to do. Only takes a few minutes to do that. When I first started doing financial models, they weren't investor grade, and then I had somebody in 2004 come to me in the CEO Space community and say, can you create financial models that look like this? Some investor prospect had given her some sample financial models and said, can you do this? And I said, sure, I can do that. And I figured out how to do it and created my process and my template and my worksheet that I worked with, and I've done it ever since. And it's something that I really, really enjoy doing. And many, many companies can get great value from having a complete investor-grade financial model. We'll talk about that here in just a little bit. But there are some exceptions to people who really don't need the complete investor-grade financial models, and those are the very early-stage companies who are not in revenue yet, and in many times really don't have a good idea of what they're going to sell and how they're going to sell it and who they're going to sell it to. And the other ones are the internet companies, or companies that have massive growth potential. Companies like Facebook, Google, LinkedIn, Twitter really don't need complete financial models. What they all need, however, is expense and fixed asset projections for the next phase of growth, or if you're raising capital, that could be the use of proceeds. So in those cases, you really don't need a complete financial model because you don't have revenues and the costs associated with those revenues, but you can use expense projections and fixed asset projections, which will consume your cash. So even if you don't need an investor-grade financial model like we're going to talk about today, I'm a big fan of budgeting. I'm a big fan of understanding where you're going to spend your money over the next 3 to 6 months at all times so that you can have a budget in place for that, and you know how to deal with financial opportunities and surprises that come through the door. So why do the projections? There's a few good reasons. Number one is if you're seeking loans or loan renewals. So when you go to a bank, oftentimes they'll ask you what your financial projections are. They'll want to know what sort of revenues and what sort of profits that you are projecting over the next several years. If you have a line of credit with a bank, and especially if you start to fall out of profile a little bit, they'll want to know what your financial projections are for the next several years, because they'll want to know whether or not it's a good idea to continue loaning you the money, or whether they would need to call their loan because it's clear that you're not going to get back into profile. And just a word about being in profile. All banks have lending profiles that they have that you have to meet. It was so much profitability, so much revenue, so much ability to repay the debt before they will extend to you credit or continue to extend credit to you. So as oftentimes happens, especially with ups and downs and the turns of the economy, that you may have been in profile when you first got a loan or a line of credit, but you fall out of profile because of changes in circumstance. So banks will oftentimes ask for financial projections to determine whether or not they want to continue loaning you the money or whether they want to call in the debt. Another good reason for doing financial projections is if you're raising capital. Many investors, when they get your business plan, they'll skim the executive summary and they'll turn right back to the financial projections because they want to know what size of business that you intend to create, and they want to know how much money you intend to generate so that they can judge for themselves whether or not this might be a venture in which they want to play. So if you are raising capital, unless you are one of the two companies that we talked about earlier, a seed capital company that's just getting started, or an internet startup company that has massive, like billion-dollar growth potential, you need to have complete investor-grade financial models. But these aren't the only reasons for getting financial models. I think oftentimes the most important reason is business model diligence, because when you create the financial model, it really facilitates the thinking it through of your business plan and of your business venture. When you do the business model diligence, getting the financial model helps determine whether or not you have your whole business venture is overall viable and it can allow you to create a profitable and sustainable business. It also helps to discover your most profitable product lines and distribution channels, and gives you some sort of judgment as to what your reasonableness of expenses might be. And in my experience of doing 150 or so, I think, financial model, there is always a surprise. There is always an opportunity to adjust your strategic plans, to go after the low-hanging fruit once you discover what the low-hanging fruit is, and to adjust the way in which you intend to grow your business based upon the outcome of the financial modeling process. It really does provide you the opportunity to do diligence on your own business model. So here's the process of financial modeling, the 8 steps that I use. There's startup expenses, sales projections, the staffing model, direct costs, operating expenses, balance sheet activity, cash flow analysis, and capital engineering. And we're going to run through each one of these 8 steps briefly and talk about them. First of all comes the startup expenses. This is the only one of the areas that I think is optional. So because some companies are already in production and they're not a startup business, that they have heavy revenue or heavy expenses already, so we omit the startup section of the financial model. But for other ones, it's most helpful to have a little startup little startup section to the financial model, usually from 3 to 9 months long, and prior to having significant revenue or major expenses. The purpose of doing this is because it tends to increase the revenue projections in the 3rd year or the 5th year, or whatever the last year of the financial model is, which tends to increase your company valuation and tends to increase the attractiveness that you might have for your investors. So if you're really not going to start business until you raise capital, for example, for the next 3 to 9 months, or if you have some abbreviated way of keeping the doors open for the next 3 to 6 months for some reason, usually it's a raising capital reason, it may be very helpful to you to have startup expenses and a startup expense area to your financial projections because, like I say, it increases the valuation in third year or the 5th year, whatever the length of the financial model is that you have, and helps make you a little bit more attractive to the investors. After I work on the startup model, then we turn to sales projections, which, by the way, can be 30 or 40% of the process. Even though there's 8 steps to the process, not every step in the process is of equal length, and the sales projections are almost always the most lengthy part of the financial modeling process. That's where we take a look at sales by product and by distribution channel. So you figure out what it is you're going to sell, what the price is that you're going to sell it, and how much you're going to sell. In fact, you need to know all these things. What products you're going to sell, the prices and cost of each one of those, the number of units sold by channel, and price variations by channel. Price variations by channel are very significant. So if you have, for example, a consumer product that you're bringing to market, it's one thing to sell it retail off of your website, and it's quite another thing to sell wholesale to people who will put it on the shelves. And again, it's quite another thing to sell it wholesale through something like Home Shopping Network or QVC. So you may be able to sell it off your website. Let's say that the product is a $100 product. You may be able to sell it off your website for $100 or $90 with discounts and only own internal commissions to your team, or some sort of an affiliate fee if you've got a link from somebody else. But if you sell it wholesale, you may only be able to sell it for $50. And if you sell it on QVC or Home Shopping Network, you may be able to sell it for $45. So it really makes a huge difference to your revenue projections and your sales projections as to which channel you intend to sell your products through. After we do the sales projections, we turn our attention to the staffing model, in where we figure out the salaries and the starting dates of everybody that you need to bring onto your company in order to support the sales projections. So if you plan to sell $10 million worth of products next year, it's going to require a much larger staff than if you projected that you were only going to sell $1 million next year. And it's not just the salaries and the starting dates of the people that you bring on board as employees, but it's also your contractors, the fees that you would intend to pay your contractors, and the engagement dates for those contractors. Usually when we do the staffing model, it's detailed for the first 12 to 18 months and much looser projections thereafter. And in the template that I use, I've got a process that allows us to automatically increase the people that we believe are going to be on staff, the numbers on staff, based upon revenue per employee assumptions. So a long time ago, we used to assume that with blue-collar companies that you could enjoy $50,000 a year of revenue per employee and $100,000 a year of revenue per employee in white-collar companies or service companies like consulting companies or coaching companies. Today, those numbers, I've seen them go even much larger than that. There are some internet marketing companies that can enjoy as much as $1 million a year of revenue per employee, but usually not much more than that. So if you plan to have a $10 million a year business, that may require anywhere from 50 employees to 30 employees to, at the very high end, or the low end rather, 10 employees generating that $1 million a year of business if a lot of the functions are outsourced to the contractors. After we do the staffing model, and before we exit this one, you also need to know what your bonus and raise position is going to be. Do you want to have a bonus pool and pay bonuses out of that on a quarterly basis? And do you want to budget into the financial model raising the salary 7% or 10% every year or so, which is usually a pretty good idea because the cost of people does go up, as does the cost of your products and products that you're using, your raw materials, etc. And speaking of those, the next section in the financial modeling process is the direct cost portion of the modeling process, where we include the product costs, the cost of purchasing either your raw materials if you're manufacturing or assembling here in the United States, or your finished products if you're manufacturing and getting assemblies from third parties, usually overseas, usually in the Far East somewhere, although we're seeing a lot of trend for getting products manufactured in Mexico. So the product costs are a classic part of the direct costs, but not the only ones for a long shots. Commissions are always part of your direct costs. And by the way, direct costs are those costs which you do not incur until you sell something. So by definition, you don't cost or treat your inventory as an expense until you actually sell the product. And you don't owe people commissions until you actually enjoy the revenue. But commissions can come at a couple of different levels. They can be internal and at all levels in your corporation, especially if you have salespeople and sales managers. Both the salespeople or individuals and their managers typically enjoy some portion of the commission. And externally, you can be paying commission, which is sometimes called agent fees or broker fees or affiliate fees or referral fees. Sometimes they're not called commissions, but just like your internal commissions, they are direct costs that you don't incur until you actually sell something. Other direct costs can be royalties. If you've licensed somebody else's intellectual property, you may owe them anywhere from 5 to 15% on the revenue that was created using their intellectual property via a royalty agreement. And last but not least are credit card fees. We talked a lot about credit card fees last week. We know that they can be anywhere from 2 to 4 to even 5%. And believe me, 5% of your cost or 5% of your revenue going to credit card fees can be 30% of your net profit. If your taxable income is 15% of your revenues per year, which by the way can be pretty good, and 4 or 5% of your revenue is caught up in credit card fees, it can be 25 or 30% of your direct costs in credit card fees. And that's why it's so important for you to manage and understand those fees extremely well, because they really do increase your direct costs for companies that are taking credit cards. And if you're taking credit cards and you didn't watch it, I invite you to go back and listen to last week's presentation where we talked in great detail about merchant card processing and the fees associated with that. And also subcontractor fees. In some cases, you may be delivering the services yourself, but in some cases you may hire other people to deliver those services. And when you're hiring other people, not generally your employees, but subcontractors or third-party companies to deliver your services, then that's counted as a direct cost as well. And after we define the direct cost, then comes the operating expenses. And oh my goodness, there's a long list of those. Here's just some of them: automobile fees, bank fees, board of director fees, communication fees. I'm not going to read through this entire list, but there are a bunch of them. I'm going to list about 30 of them here: payroll, taxes, and printing. And on the next page, product development, software, travel and entertainment. And it takes a little bit of time to go down all of these our operating expense categories and define what your operating expenses are likely to be for your particular business. And it varies immensely whether or not you're a virtual business or whether you're a business that has a large office environment or whether you've got some of your employees in the central office and some of them virtual. There's a lot of conversation, a lot of questions that go in to the operating expenses portion of the financial modeling process. Some of these operating expenses will vary over time as your staff increases, so it's really important to do the staffing projections before we do the operating expense projections. And some of them increase over time as revenues increase. Sometimes people call operating expenses fixed expenses and direct cost variable expenses. I'm not a particular fan of that terminology because in my experience, fixed expenses really aren't fixed. Your operating expenses go up over time as your company's revenue go up too. They just don't vary as directly as do your direct costs, what we talked about before. So usually in my financial models, by the way, we have some sort of percentage increase factor year over year. We budget what the operating expenses are going to be for the first 12 months and then let that increase year over year, typically at some percentage of revenue or some percentage of the previous year's operating expense projection. After that comes the balance sheet activity. And by the way, most companies, if you're not doing investor-grade financial models, they stop after the P&L. They stop after doing the sales projections and the staffing models and the operating expenses, but that doesn't tell the story of your cash nearly as well as when you go in and do the next 2 or 3 sections of the financial model. With the balance sheet activity comes a discussion about how much of your current charges or your current expenses can be deferred with accounts payable or notes payable. How much of the cash that you generate needs to be allocated for a distribution of profits. And in some companies, you have mandatory distribution of profits, especially if you're an LLC or a subchapter S corporation, where your shareholders may enjoy some income. If you don't distribute profits enough to cover their tax liability, it's phantom income to them and can actually decrease their cash flow. So with some companies, there's a mandatory distribution of profits. If you're a C corporation, there may not be, but most other companies, by practice and in some cases by agreement, have some sort of mandatory distribution of profit that impacts the cash on hand and is a balance sheet activity. For the assets section of the balance sheet, you may also have a discussion about accounts receivable. So if you take credit cards, you typically get that money in 2 or 3 days, but if you're dealing with other outside companies, you may need to send them an invoice and wait 30, 45, even 60 days, and in some really bad cases, 120 days for them to pay you. And it's incredibly important that you note that in your financial projections, because your accounts receivable is one of the ways in which you consume cash enormously, and we need to factor that into the financial model. You can also have notes receivable, where people owe you money on a long-term basis, prepaid expenses, which also consume cash, and inventory, which consumes cash as well. But a very big part of the balance sheet activity are those fixed assets. Fixed assets contain a lot of different sections. Buildings and land, if you have to build a building or buy a piece of property. Computer equipment, even the laptops on your desk or the desktops that you have, the towers. If you have 20 people and you have to spend $2,000 each or $2,500 each on a computer so they can work with you, that can be a lot. Office furnitures and fixtures. You may have to spend anywhere from $5,000 to $10,000 for a cubicle and a desk, and for other things to facilitate employees at your company. For some companies who are building things, you might have plant machinery and equipment. You may have product development costs, which cannot be expensed in some cases, and they need to be capitalized and put on the balance sheet. And the most common one is trucks and automobiles. Of all of these different categories for fixed expenses, the office furniture and equipment or fixtures, the computer equipment, and the trucks and automobiles are the most common. But we need to talk about that because each one of those consumes cash in a way that typically never shows up on a profit and loss statement. It only shows up on the balance sheet and in the cash flow statement. And after we do the balance sheet activities, then we do a cash flow analysis, which is a month-by-month analysis of your sources of funds and your uses of funds. And what we find out during this section of the financial modeling process is it really does take a lot of cash to grow your company. Cash for additional inventory, cash for accounts receivable, cash for fixed assets that we just talked about, cash for marketing that you need to spend in advance of revenue, cash for staff that you need to have on board in advance of selling things and delivering products and services, and cash for working capital. All of those things consume cash, and we note them by doing a cash flow analysis. And typically it's during this section of it that we understand how we can adjust the strategy in order to reduce the amount of cash that it takes to grow your business, and makes a huge difference when it comes to the final section of the financial modeling process, which is the capital engineering. We take a look at several factors when it comes to doing the capital engineering. And by the way, I define capital engineering as understanding how much money you need to grow this business and at what stage of the business life you need to have that money and how much of your company you might need to sell in order to get that money. In order to do that, we need to understand the cash that's actually required for you to grow your business, your earnings projections, which can give us a valuation of the company, and typically that can be on three different methods. There's the Harvard method of valuing your company, the internal rate of return method of valuing your company, and a fair market value method of valuing your company too. So after we understand how much cash is required, what your earnings projections are likely to be, what a reasonable valuation multiple may be, we run it through several different company valuation methods so that we can figure out what portion of your company to sell in order to give your investors a reasonable return. So those are the 8 stages of doing a financial model. I'm sorry I'm not going to repeat them here. I've omitted that agenda slide. But they're the startup expenses, the sales projections, the staffing expenses, the direct costs, the operating expenses, the balance sheet activity, the cash flow analysis, and the capital engineering are the 8 sections to the financial modeling process that I use. And here's some tips in addition to what we just talked about. It really does take great spreadsheet expertise, accounting expertise, and domain expertise to create reasonable financial models. Most CPAs that I know of and bookkeeping firms don't do financial projections. Many of them are historians and bookkeepers. They only look at where you are today, and they look at the past with the great skill set of making sure that you're tracking things appropriately. But it's only a few of them, a small percentage of them, that have the skill and the aptitude and even the inclination to do financial modeling. It does take a lot of spreadsheet skills and accounting expertise and domain expertise. And by domain expertise, I mean experience in your particular industry, so you understand what reasonable commissions are, what reasonable revenue per employee guidelines might be, what reasonable prices might be, what costs are for the products are that you intend to sell. You know, I've done so many financial models that I know a lot about a lot of different industries, but I always encourage my clients to get that domain expertise on their side, to have somebody on their team who has been there and done that in their particular industry so that they can add considerable value to the strategy and considerable value to the financial model. And like business plans, financial models need to be updated every 90 days or so because business changes. And if your financial projections, especially your financial history is a part of your business plan, you have a legal obligation if you're raising capital to give very current, up-to-date results. And that means oftentimes adjusting your financial models too. Here's a couple of more tips. Some financial modeling professionals don't deliver the spreadsheet to you, and you have to continue to engage their services to make changes. I remember the first time I hired a graphic artist, and they got me one of my first logos for my business, and I asked them for the raw data, and they said, no, we don't deliver that. We only deliver something that you can use in your print and on your website. But they actually retained the rights to the original graphic material. I didn't have as part of my contract that it was a work for hire. So they kept the intellectual property rights and they kept all the raw files, and if I wanted to tweak the model in any way or the graphic in any way, I had to continue to hire them to do so. And some spreadsheet folks are the same way. I'm not that way, by the way. If you would ever engage my services to do financial models, I always deliver the complete Excel spreadsheet that you are welcome to update on your own if you choose to do that, and especially is a nice thing to do if it's just a minor update. You can do that. If it's a major update that impacts, something significant about your financial model, you may want to come back and I have some clients I've worked with for years to help tweak their financial model, but you don't necessarily have to do that. Another tip is that it really takes month-by-month balance sheet, income statement, and cash flow statements in order to understand the cash that is required to build your business. It's always a surprise to find out where your cash is really going and what is really contributing to your cash and where that low-hanging fruit is so that you can adjust your strategy to consume less cash and reach financial stability as quickly as possible. And for those of you who have listened to my Business Survival Bootcamp product or my Beyond Business Survival product, you know that I am relentless in my pursuit of financial stability. The two most important things that I want you to focus on are engaging with the marketplace just as quickly as possible, and secondly, to reach financial stability. And there are things that you can do once you uncover the true nature of the cash being utilized in your business to adjust your strategic growth plans so that you can reach financial stability much quicker and consume less cash than you would otherwise. And the last tip is maybe the most important tip, and that is that no financial model ever comes true. Of the 150 or so that I've done, not a single one of them, not a single one of those companies ever showed up, ever came to light in exactly the way that we projected it. We like to be close. If we can get within 10 or 20%, that's a pretty darn good deal, because it's very difficult to project how the market is going to react, what the real prices are going to be, what the real expenses are going to be. So we try to be conservative, and we try to put in a lot of working capital and contingency funds so that you have a decent shot at creating the revenues and creating the profits that you share with yourself and with your investors. So here's your homework and your exercises. Think about when and if a financial modeling process might be just exactly what you need to take the next step in your business growth. If you're just getting started, then maybe that's a very simple financial model with expense projections and any fixed asset projections you have. But if you're raising capital and you're not, a company that's going to be $1 billion in 4 or 5 years, then it may be very important for you to create an investor-grade financial model. If you choose to do that, always get multiple quotes and multiple references. Check the references of the people that you may want to hire to do the financial model. Make sure you understand what they're going to be delivering it and when they're going to be delivering it. And I really do recommend that you work with a professional of this, whether it's me or somebody else, so that you get that third-party perspective. I've worked with hundreds of businesses, and I learned something with every one of them. When I first began being a business consultant in 2001, I was proud of the knowledge and the experience that I had gained in over 30 years of business experience. But as with the value of experience, I'm a much better consultant today and a much better financial modeler today than I ever was, especially when I started being a consultant 8 or 9 years ago. And part of that is that perspective that I've gained from working with hundreds of businesses out there. So, and by the way, when we put up the office hours recording, I'm going to be offering sample financial projections, so you'll see exactly what I mean when it comes to the investor-grade financial models with the 6 different worksheets that come with that. We're going to have open questions and answers in just a minute. Comments and questions on the subject of the day are invited, and then any other issues that come out. First, I want to talk to you a little bit about the programs that I have. I provide services in 3 different areas. My consulting coaching services, I've got a library with a membership program, and my Beyond Business Survival CEO training program. First, with the services, of course, I do financial models. I also do strategic plans, business plans, empowerment coaching, and several other things. And those programs start as low as just a couple of $100s. And in mid-January, we announced the Paul Hoyt Library that I just spent a lot of time putting up a lot of documents with it. So it contains all of these office hours recordings. This is number 20. And dozens of other business document templates, spreadsheets, processes, procedures, agreements, step-by-step methods that you can use to do things for your business. We also be putting up some bonus inspirational messages. As most of you know, I'm not only a small business consultant, but I'm also a powerful advocate for personal and spiritual growth. So I'll put up some messages and maybe even, who knows, maybe even a song or two in my library area. And I continue to add to it every week. You have 3 pricing options for the library. You can have a lifetime membership for $279, an annual membership for $79, or a monthly membership for $9.38 a month. It's no risk, money back guarantee. The Beyond Business Survival CEO training program is that critical small business owner training that you need. It's what you need to know when you're the CEO. So because if you don't get the training you need, you're likely to make a lot of critical mistakes that will slow you down or shut you down. I think this program will save you from $10,000 to $20,000 or $50,000 or more. It is a self-paced, on-demand learning program that you can go back and access whenever you like. It's audio with complete transcripts with dozens of success principles. It's only $497, and right now as a special offer, when you purchase Beyond Business Survival, you also get a lifetime membership into the Paul Hoyt Library, which is a $279 value. And as always, it's no risk and a money-back guarantee. I invite you to join me on Facebook and get your energy of the day. For the last 55 or 58 days, something like that, every single day, I've been publishing a little inspirational message. So if you like me and become friends on Facebook, you can get that one. Next Monday, we are going to talk about who does what, transfers of value in partnering relationships. So when you partner with somebody, how to decide who gets what portion of the money based upon the value that they're bringing to the engagement or bringing to the solution that you are providing to your client. I think that's going to be a very interesting discussion. It's going to be a little bit more in-depth. I did an office hours presentation a few weeks ago, and I can't remember exactly which week it was, on joint ventures and talked about the principles in partnering. And this is a more in-depth treatment of that, where we're going to talk about who does what and how you split up the money in between you and your partner. I also invite you to let me know what other topics you'd like to see me address on these office hours presentation at paulsurvey.com. Do your homework that we mentioned and contact me however you like at paul@paulhoyt.com or give me a call at 415-997-8001. Or if you'd like to schedule a little meeting, just go to schedulepaul.com and pick a time that works for you, and we will chat. Audra, that's the presentation for today. Did we have any questions?
Paul, we did.
Wonderful.
So Carol wants a little bit more explanation of what you meant by domain expertise.
I think a substitute word for domain might be industry expertise or your particular business expertise. So, for example, if you want to start up a restaurant, you need to make sure that you've got people on your team who have a lot of experience in the restaurant industry so that they can help you with your financial models and with your strategies for growing. If you're bringing a consumer product to market, you want to get somebody on your team who's brought a consumer product to market before. If you're a coach, you want to make sure you've got somebody on your team who is a coach or has been a coach or who has trained hundreds or thousands of coaches so that they can help you figure out what the business model really looks like and what the financial model should look like. So when I say domain experience, that's another word for the industry or the particular business in which you are going to be engaged. Next question, Audra.
Okay, and we have sort of a follow-up from Carol again. She says, with a nonprofit, is it the same information required because it says nonprofit as opposed to a for-profit?
There's a lot of overlap between nonprofits and for-profits, especially when it comes to the expense projections. And many nonprofits have programs that they sell or services that they sell in addition to seeking donations. So when it comes to forecasting whether or not you're making any money selling the products and services in a nonprofit and forecasting the operating expenses, there's a lot of overlap. Where there is not a lot of overlap is when it comes to the revenues. It's because the revenues and the way in which you raise funds. So nonprofits, by definition, take donations, and you cannot have investors at a nonprofit. So I have a little experience working with nonprofits, but not very much experience working with nonprofits. So I would encourage you to get somebody on your team who has a lot of experience working with nonprofits. I have worked with nonprofits, by the way, that had for-profit subsidiaries that they owned. And what we found was that if you have a for-profit, nonprofit hybrid model of any kind, that there are very specific things that you need to pay attention to. Number one is you have to have a different management team. The for-profit has to have a different board of directors or board of managers than does the for-profit. And the mindset is a lot different at a nonprofit than it is a for-profit for most of them. For for-profits, we love salespeople and we love to pay them lots of money because they're the ones bringing the money into the door. Typically, we'll have bonuses and incentives for our employees and don't mind paying a lot of money to our employees as long as they're generating business and allowing us to perform at a profit. But with a nonprofit, the mentality is much different. Typically, there's not near as many bonuses or incentive programs. We don't pay the salesmen very much in the commissions. Salaries and wages are held down. It's a much more of a volunteer kind of a mindset than it is a for-profit, let's make a lot of money kind of a mindset. So I know a little bit about nonprofits and for-profits, but I still would encourage you strongly to get somebody on your team that has a lot of experience in running nonprofits, because most of my experience, and by most I mean like 98% of all of my experience, is in dealing with for-profit entities. Next question, Audra.
How long does it take to do one of these things?
You know, I think everybody who's a professional financial modeler has a different process. My process takes about 8 hours. I've done them in 6 hours. I think my world record is 5 hours, and that means running through all of those 5 steps and coming out the other end with investor-grade financial models in as little as 6 to 8 hours. Sometimes we do that in terms of a one-day session where we take a break every hour or so, every couple hours for a few minutes and then take a lunch break. But a lot of times we schedule it with 2 4-hour sessions, one like this afternoon and one tomorrow afternoon. I don't like a lot of time to go in between those sections because you forget and you have to review, and it takes a little more time if you space them out like that. So my preference is 2 4-hour sessions back to back on two successive days. Other people, by the way, can take weeks. I've had some people come to me and say that I engaged another person to do the financial model. They've been at it for 3 or 4 weeks, and I still haven't gotten what I want. Or they charged an excessive amount of money, and I haven't gotten that. But one of the, I'm good at a lot of things, but I will very humbly and confidently claim my genius at financial modeling. Of all the things that I do, that's one of the things that I do really good, and I can crank them out in about 8 hours or so. So thanks for asking. Next question.
Well, Paul, you walked right into the next one. So how much does one of these things cost?
Did you say how much does it cost to do?
I did.
They vary, and go get quotes from a lot of different professionals out there. I've seen them be anywhere from $2,500 to $5,000 for somebody to do your financial model. I'm on the low end of that when it comes to doing financial modeling. So I'll just leave it at that because, frankly, my prices vary. They vary as to what I think the complexity of the financial model is going to be. They vary as to whether or not I'm booked up. If I'm booked up solid for the next 6 weeks or so and you want to book the time, you're not near as likely to get a discount as if I've got a hole in my schedule and I'm eager to get started tomorrow. So my prices vary a little bit, but I'm on the low end of that $2,500 to $5,000 range. Next question.
So if I don't really understand spreadsheets, how can I work with a financial model?
Another great question. And the answer is, I think, very carefully. When it comes to core competencies in business, every once in a while I find a business owner who is not particularly gifted at emails or not gifted at phone skills or not gifted at word processing or not gifted at spreadsheets. And you don't have to be gifted in each one of those areas, I think, to be effective as a CEO, but it's nice to have some level of competence to be able to understand what a formula is and what a value is, or at the next level, how you link, how a value on one worksheet can be transferred to another worksheet in a workbook, and how to have references and use some more advanced functions. But if you're not very familiar with spreadsheets at all, if your hands start shaking whenever you start to click on opening up Microsoft Excel. Then I recommend that you get somebody on your team that can help you out with that. And it could be a professional financial modeler, or it could be your own bookkeeper, or it could be your own accountant or your own CFO, and somebody that can take that on at your business. Because it's one thing to deal with a very simple spreadsheet that just has a few basic formulas. You know, we're just adding up the dollar amounts that are in a particular row or column. And it's quite another thing dealing with a sophisticated financial model like I have a tendency to produce that has 20 worksheets all interrelated, and you know, you really need to be cautious about the values that you change in that. So I think the short answer to that is you do it very carefully and you get help with it. Next question, Audra.
I'm going to intersperse a comment that Darlene made.
Okay.
That fits right in with that. She said, for my resort development company, we did exactly what you teach. We started with the basics when our CFO joined the team. We got the comprehensive projections completed. Since then, I referred everyone to my CFO when they had a question, but I never understood completely what I was looking at when I reviewed the projections. I always relied on my CFO to explain everything. So she really appreciates this knowledge and overview. Now she understands what she's looking at. She didn't really have a question. She just wanted everyone to understand, as a person who's done this, how valuable the information Paul is teaching us today is.
Well, and I thank you for that. And I always encourage the CEO of a company to at least be able to read financial statements, to at least be able to understand what's being represented on a P&L and the major sections of a P&L, and understand what's being represented on a balance sheet, and understand what's being represented on a cash flow worksheet as well. Because it's not just that you want to look good in front of investors, it's that's really valuable information. There's a reason why we have these different worksheets. There's a reason why we have these financial statements. And it's because it gives you extremely valuable information that you can use to make great decisions on how you run your company. So I may do an office hours in the future on reading financial statements, just the very basics of what a P&L is and what a balance sheet is and why we look at these things and why they're important for us to understand how to look at them and how to read them. If you'd like me to do that, just go to paulsurvey.com or give me a ring or a shout out in some way. And if I see some interest from folks out there, I may do that in a future office hours presentation. Next question, Audra.
Paul, just me saying I'm interested in that, so I just voted yes on that office hours.
Okay, so we got one vote in favor of just the understanding financial statements at a high level. Fantastic.
Oh, it looks like we got a lot of people piping in me too. Awesome.
Okay, cool.
So Chuck is asking, how many years of detail is appropriate for investor grade? Isn't anything over 5 years simply a swag?
Well, I think, by the way, anything over about 12 or 18 months is a swag. You know, it's one thing to look out over the next 12 months and project, but, you know, to understand what's going to happen 3-5 years down the road, that's really, really tough to do. The closer in, the greater level of predictability that we have, and the further out, the more we're just, you know, throwing blindly at a dartboard somewhere. Honestly, most of the financial models I do are 3 years long. Most investors really like to see a business that's going to break even in 18 months or less and really begin to generate substantial profits within 3 years. Some of them I do are 5 years. I would say 10% of the models I do are 5 years long. And usually that's because there's a heavy product development phase up front that consumes considerable expenses. One of the clients I'm working with right now is developing technology and needs to build a manufacturing facility. And it's going to take them 2 years to develop the technology and to create the facility and get into the facility with the right machinery and equipment before they really even get into revenue. So we needed to have a 5-year model in order to even determine what the break-even point was. And I have done one model that was 7 years in length, and that was a medical device company that, again, had a very long product development cycle. It was like 2.5 to 3 years before they were ever going to get into revenue. So we had to carry the model out 7 years in order to be able to show profitability and really give the investors, I would say, a positive attitude towards the future profitability of that company. Hope that answers that question, Chuck, and thanks for asking that. Next question.
So Tony is asking what the main difference between an investor-grade financial model and one that you would just use internally for your small business.
That's another good question. I'm such a fan of the balance sheet and the cash flow statement and the information that they provide, again, providing critical information to you about how you build and how you grow your company, that I'm a big fan of every small business having an investor-grade financial model. That being said, there are some businesses which are very simple and they don't have a lot of balance sheet activity and they don't have a lot of accrual activity or other activity that impacts the cash. So just simple P&L might work. And a good example of that would be a coaching business that does all their business on credit cards. There's no accounts receivable. You don't have to spend a lot of time and money on product development. There's no real fixed assets associated with that. Typically, it's a virtual business that doesn't have an office and all of the expenses associated with that. May or may not have any employees whatsoever. So very simple businesses that work primarily on a cash basis or primarily on a credit card basis, all you really need is the income statement or the profit and loss statement. And by the way, those are the same thing. An income statement is another word for the P&L or the profit and loss statement. But any company that has any sort of offices, that has any sort of product development expenses, that has any sort of fixed assets associated with it that need to be capitalized, that bills their clients and has a substantial portion of their revenue in accounts receivable at any one particular time, or a company that has inventory of any way, then I think it's very important for you to have an investor-grade financial model, because it's only by taking a look at the balance sheet activity and the cash flow activity that you can really determine what your cash requirements are. That's a great question, and thanks again for asking that. Next question.
So we have somebody who did not want to be identified, but they're saying they're just a solopreneur. It's just them. Do they need a financial model, and why, if they do?
I think you at least need revenue and expense projections, and I encourage you to look out at least 3 to 4 months with some simple budget. If you're a solopreneur, I'm a big fan of budgeting. In looking at your overhead expenses, for example, in my particular business, I have several $1,000s worth of overhead in terms of the Infusionsoft licenses and all the add-ons that go with that, the credit card fees, the obligations I have to some of my contractors, other things like smart sheets and a lot of other software in the cloud or software as a service that I use every day in my business. And it's really important for you to create a budget to where you really understand what your overhead is for your budget, even if you're running a virtual office and even if you're a solopreneur. So you may call it a budget instead of a financial model, that's fine, but at least do a budget of your expenses so you know how much revenue you need to have every month in order to break even and to show a profit in your business. I think that's the minimum level, is an expense budget. The next level up would be, some sort of P&L or some sort of revenue projections tagged on to that, so that you can make good decisions about when you incur additional expenses, and especially make good decisions about when and if you increase your monthly overhead and increase your fixed expenses or your operating expenses, because that's oftentimes a really big decision for very small businesses to make. Hope that helps. Next question, Audra.
So I'm not sure whether you answered this before, but there is still a question. What is an investor-grade financial model?
I consider an investor-grade financial model to be 3 different sections: the income statement, the balance sheet, and the cash flow for month over month for year 1 and year over year for either the next 3 to 5 years, depending on how long you extend the financial model. And when I put up this recording, I'll give a sample of what I consider an investor-grade financial model to be so that you can take a look at that. But that's what I consider. And the reason it's investor-grade is because investors know how important it is to really understand how you're spending your cash. And that's what makes it investor-grade, is that we've paid a lot of attention not to just the income and expenses that we are projecting, but also the way that we are using cash on all of those other things I talked about. Marketing expenses, staff in advance of revenues, any sort of fixed assets that you might have, accounts receivable, accounts payable, inventory, all of those things consume cash, and investors know that, and that's why I consider it to be investor grade when it has those 6 different worksheets with it. Thanks for asking. Next question.
This one is a little bit of a sideways question.
Okay.
Somebody was intrigued with the 7-year plan that you had to come up with, and maybe they're in a similar position. They want to know, how does a company hold up until then? I mean, if they didn't have any money coming in.
Massive amounts of capital. I mean, medical device, if you listen to the Business Survival Boot Camp, I talk about introduce a concept called the business complexity profile. And I talk about very simple businesses versus very complex businesses. And as it turns out, a medical device business, a medical device company, is the most complex business model I've ever seen. It is extremely complex because of the intellectual property and because of the regulations associated with that from the FDA and the certifications and the clinical trials and all of that stuff required. It just takes a long time and costs a tremendous amount of money to bring a medical device or a pharmaceutical product to market these days because of the regulations and the certifications and all that stuff that's required. So the only way to do that if you're a medical device company is with a massive amount of capital. It just takes a lot of money to build a medical device company. And by the way, it's 12:59. I'm going to, or right at 1 o'clock, maybe a little after. I'm going to stay on the line here for another 10 minutes or so and answer some more questions as long as they keep coming. And if you have to bail out, well then please go listen to the recording and catch the last 5 or 10 minutes of the questions and all of the homework and exercises. And I look forward to connecting with you soon. With that brief saying goodbye to those who have to exit, Audra, do you have another question?
Well, believe it or not, we are out of questions. But I did want to say to the person who was interested in that, Paul did an office hours recently about raising capital. So if you're in that position, definitely go check out one of the more recent office hours.
Yep, that was on the 6 stages of raising capital. I think it was only a couple of sessions ago. So it should still be up online and free. And if it's not there, it'll be in the membership area that can come at a very low monthly rate. So at the end of those questions there, I'd like to thank you all for attending. I really do appreciate it when you show up. It's very nice to have an audience. And I know a lot of people out there are listening to the recordings as well. Until we talk again next week on transfer of value and who gets what in partnering relationships, this is Paul Hoyt wishing you a most marvelous and prosperous day. Goodbye.